This is the Money Seat Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seat Podcast. My guest this afternoon is Chad Hufford from Veritas Wealth Management from all the way up in Alaska. Chad, welcome to the show.
Gabe, thanks so much for having me. It's a pleasure to be here.
Chad, please give us a brief intro. Maybe talk to us about the firm, Veritas Wealth Management, as well as yourself. And I always get confused about the various designations and certifications between certified financial planner, wealth advisor, all that. So tell us about you and the firm.
So Veritas Wealth Management, we're based here in Anchorage, Alaska, as you said. We work with folks all over the country. And really, there's a lot of financial professionals out there, Gabe, promising to help people find better investments. Yes, that's important. I think our big differentiator is helping people become better investors. And those are two entirely different things. Giving somebody better shoes doesn't necessarily make them a faster runner. Giving somebody a nicer pen doesn't make them a better writer. It's actually working with the individual to make them, to optimize their behavior, their mindset, with the tools that they already have access to. So, the gist of what we typically do, a lot of people come to us for retirement planning, to create retirement income strategies, develop financial plans around that. So the long and short of it is, we exist to make sure people don't run out of money or purpose in retirement.
I love it. So let's start right there. Let's start with retirement. And a lot of Americans are told, you know what, just get a W-2 job, sock your money away into 401ks. Hey, maybe your company will give you a small match as well. You got nothing to worry about. That pile is going to grow and grow. It's going to be huge by the time you're ready to retire. And yet the statistics tell us that a lot of Americans are not, it's not working out that well for some Americans. It's working great for, but some Americans are shortchanged. But what is your view on that? And is there anything missing from that advice?
Well, it's easy advice to give. Just max out your 401k, invest in a wide variety of companies, and stay diversified, and come back in 30 years and you'll be great. The problem is life happens and people don't invest enough and they get scared out of markets. They try to time markets and they're trying to chase fads and all these different things. So the tough part about that advice is people are not forced to save enough and to save correctly. So a lot of people do end up with a big shortfall as they get closer to retirement. And it's not that you can't build tremendous wealth with just a 401k. It's that without the accountability, without having a plan to guide your saving and spending decisions, most people simply don't.
So a lot of people just sock their money away into some random mutual fund. Most people probably don't even know what mutual funds their 401ks are in. You mentioned the word diversification a few minutes ago in your intro. When you work with your clients, what does diversification mean to you?
The simplest, best example or definition that I've ever been given was by Nick Murray, who is the author of many, many books. Simple Wealth, Inevitable Wealth is his book written to investors. But he says diversification is not having enough money in any one thing to make a killing. But most importantly, it's not having enough money in any one thing to get killed. And that's the tenet that we go by. So you're not trying to guess. You're not trying to get the next best investment. You're using what's always worked. And too often people use diversification as a license to own a little bit of everything with no strategy. Just throw spaghetti at a wall to see what sticks. Or they simply chase after what has been doing best most recently, which means you're paying a premium for that thing. And we see both of those as mistakes. And of course, there's a lot of room in between, but those are kind of the extremes.
And do you ever encourage your clients to diversify away from the stock market? Or do you, basically, instead of saying, hey, you know what, you already have $500,000 in various 401k, like mutual funds, index funds, you're doing well there. Hey, you know what, why don't you try and join a real estate syndication, or get in some investment properties, or invest in a franchise or something else that can generate cash flow and assets outside of the stock market?
It really depends on the individual, what their goals are. And, for a lot of people, I think their income and their 401k are the most powerful tools for building financial independence. A lot of people don't want to deal with owning property, especially, for folks that want to travel to do more things. I mean, there are certainly benefits, but you do not need to be an expert investor to be a successful investor using mutual funds, using 401k or an IRA. Real estate is much harder. You have, not to say you can't make a lot of money, but you have to be much more involved. And there's a lot of people who merely collect real estate and don't have good metrics for what the real estate needs to hit. I talked to somebody, Gabe, just a few weeks ago. They came in, a bunch of different things going on, no real comprehensive strategy. And he had about $3 million in real estate, over $1 million in equity. So like, I don't remember the exact figure, say 1.7, 1.8 in debt on the 3 million. So, but significantly over 7 figures in equity. And I was asking him some questions, and he eventually comes back to, well, it cash flows. And I'm thinking, well, with $1 million in equity, it better cash flow, but that shouldn't be the standard. And I think there's a lot of people out there that are told, get started early, get some real estate, and they throw their money at things that just the numbers don't make sense. It doesn't mean you can't make money, but at the end of the day, it's more of a forced savings plan than a true investment. And you said it's not just real estate investors. You said a lot of people in their 401ks don't really understand what they're investing in. Target date funds have overwhelmed the 401k marketplace. So in most plans, 401ks are dominated by the target date funds. The majority of investors are using target dates, which is kind of a one size fits all. And as you know, that means one size fits nobody. It's like that giant T-shirt that you got when you were a little kid at a basketball game or something like that, and you could put a belt around it and turn it into a dress because it was that big. And it's not fitting you. It's just something that you put on, and so I think a lot of people are lacking intentionality on both sides, whether it's mutual funds and a 401k or real estate. They don't really invest strategically based on a desired outcome. They're kind of just collecting investments.
When you mentioned that you help your clients become better investors, maybe give us some examples of what are some ways that clients are not good investors, or what are some mistakes that people make with their investments?
Well, number one, I don't think people have a very good definition for money. And when I just said that, when I said money, I'm guessing a lot of your audience and most of America goes to currency, units of currency. And well, money is $100 bill, it's a $20 bill, it's $5,000 in my bank account. That's money. Currency represents money, but I would challenge you to challenge your audience to consider money as purchasing power. It's the amount of goods and services that you can consume or acquire with that amount of currency. But currency gradually diminishes in value over time. So it's really not a good measure of money. And if our focus is conserving currency rather than purchasing power, what ends up happening is what we see with a lot of retirees is a lot of their money gets shifted, a lot of their investing gets shifted towards fixed income investments. Well, fixed income in a rising cost world is a recipe for disaster. So if our definition of money is units of currency, well, that's what we try to protect, but we're fighting the wrong dragon. It's the wrong battle. By conserving currency, we end up actually adding more risk to our money. And what I mean by that is a lot of people we're so afraid of volatility that's the battle we try to fight. We try to protect currency while we leave our actual income, our purchasing power at risk. And so we tell people all the time, like, I'm not so concerned about the value of your investments at any given time. That's not how much your net worth, how much everything would be if you liquidate it and sold it. What I'm most concerned about is starting around the time you want to retire, how much income can all those sources produce? So how much your real estate is worth, how much that fourplex is worth, how much your 401k is worth. Those are all cool numbers to brag about at the bar, I guess. But how much they're worth today is not nearly as important as how much income they can produce over your lifetime. So long-term income, protecting purchasing power, that needs to be the focus, not temporary principal.
I like that. Yeah, it seems like you have to shift away from an asset mindset to more of a cash flow mindset as you start
Yes.
to get closer and closer to retirement, which makes total sense. On that note, about the erosion of purchasing power, historically inflation was under control in America, and you can kind of look out and say, okay, you know what, 2.5% inflation a year, project that out 30 years. Nowadays, inflation is kind of more unpredictable. When you use your models, what are you using to project inflation out 30, 40 years?
Well, let me just push back a little bit against that. So if you look at the last 20 years, inflation is still under 3%.
Correct.
So we had a lot of years where it was significantly lower than average, and in the last couple of years doing what they did, right? But so if 3% is under control, it's still very significant. So if you look at the average retiree today, according to the U.S. Census Bureau and the Bureau of Labor and Statistics, the average retiree in 2024, as we're recording this, was born in 1962. It costs over $1,000 today to purchase the goods and services that $100 would have purchased the year that that person was born. So just in the lifetime of the average retiree, 62-year-old person today, their purchasing power has declined 90% based off of a unit of currency. So $1,000 today buying what $100 did the day they were born. That's average inflation. That's 3%. And that's extremely significant. So even at 3% inflation, a retiree has to be able to double or maybe even triple their income over the course of their retirement. If we're looking at 20 to 30-year retirements, double or triple their income. And it's just really hard to do that with fixed income sources. And that's where real estate and owning equities are so important. And when I say equities, I'm not talking about individual stocks. I think with our basis of diversification, mutual funds provide the opportunity to own hundreds or thousands of individual stocks inside a mutual fund. But both of those, whether it's owning real estate or owning companies, you actually own something. When people put their money in a CD or they buy bonds, I'm not saying there's never a place for that, but I think it dominates an investing strategy for a lot of retirees. And what you're essentially doing is just buying debt. You no longer own the company, you no longer own the real estate. You're a loaner, not an owner. So I'm just a firm believer that throughout our lifetimes, we need to maintain ownership. Because as long as we own what's producing the income, regardless of what inflation is over the next 20 years, whether it's 2 or 4 or 5%, as long as we own what's producing the income, I think that gives us the best shot to overcome decades of eroding purchasing power.
It sounds like you're saying maybe people shouldn't jump to have a bond dominated portfolio as they get older. Maybe it seems like, you know what, don't go that heavy on the bonds, keep more of the stocks and equities because the long-term growth prospects will be better. Is that what I'm hearing?
You have to own assets. Absolutely. Again, for some people, it might be real estate dominated. For other people, it might be mutual fund dominated in a 401k or IRA, but you have to own things. So nobody would argue against us, Gabe, that costs are rising. We are living in a rising cost world, and it's happened very rapidly here recently. Why would I take fixed income into a rising cost world and not expect problems? I'm guessing nobody here knowingly signed up for a job where they were promised, come to work with us for 20 to 30 years. We promise we'll never give you a raise. Your salary is guaranteed and fixed. That doesn't sound like a good idea for anybody.
Right.
But yet retirees sign up for that all the time as they move more and more of their money into bonds and other fixed income sources like annuities. And again, Gabe, I'm not saying those never have their place, but they are usually way too large of or make up a much bigger proportion of the strategy than they really should for most retirees, because it's really hard to keep up with rising costs when you have a fixed income.
Quick question. Let's bring it back to maybe young people who are in their early to mid 20s. Let's say they just graduated from college. They're just looking forward to getting their first job. It seems like they got to start thinking about retirement like right away. and probably they should start thinking about developing the right money habits and maybe like starting to save money, because they really shouldn't postpone it. But what is some of the advice you would give to someone who's 25 to make sure that they're set up properly for their retirement years?
Well, it's interesting you asked that because I think, especially for younger people, but anybody of any age, sometimes it's what we eliminate that has a bigger impact than what we add. And here's what I mean by that. Um, especially for a young person, if they can eliminate the habit of being in debt at an early age, that gives them so much more freedom to pay themselves, to pay the future versions of themselves. But too often people spend, and this is at any age here in America. I mean, you look at the statistics, a 25-year-old versus a 55-year-old, most of them are still drowning in debt. By the time we're 55, though, the problem is we've got a 35 or 30-year habit of paying for past purchases. I'm still paying for the car that I bought 5 years ago. I'm paying for the house I bought 15 years ago. I'm paying for the TV I bought 6 months ago. I'm paying my ex-wife, like whatever. We're paying the past instead of paying ourselves in the future. So I think for young people, one of the biggest things they can do is avoid the trap of debt, because debt is a burden that you carry around with you. It's like trying to climb a mountain or run a marathon wearing a backpack full of bricks. So before we figure out what to add, sometimes we need to eliminate. And for a 25-year-old, if they're free and clear, no student loans, no credit cards, great. I think, Roth IRA or starting, at least getting your employer match is great. But for people who are burdened by debt, uh, you know, it's great to start building your financial house, but you don't want to build a financial house in the middle of a forest fire. Let's put out the fires first and then worry about building the house. So sometimes people need to play a little defense before they play offense. And I'm using a lot of metaphors right now, but you know, it, but debt is not just a financial burden; it's a huge psychological burden, and it does become a habit. And
Mhm.
that's why I'm probably beating a dead horse right now. But if people can eliminate that behavior from their life when they're young, oh my goodness, it frees them and unburdens them to run this race towards financial independence so much faster.
I couldn't agree with you more. Let's say somebody does get out of debt and they have good money habits now. How much do they need to save? I've heard things like the 50-30-20, and there's some other variations of that, but how would you advise somebody in their mid-20s? How much should they be saving, let's say, of their pre-tax salary?
You're going to hate this answer, but it really depends on long-term goals. So Dave Ramsey talks about the 15% rule, pay off all your debt, put a nice emergency fund aside, and then 15%. Well, if you're starting at 20, you might not need 15%. You're starting at 45, 15% might be way too low. So we encourage people to begin with the end in mind. And we actually have it's called Your Retirement Target. It's a calculator on our website. And what it does is it takes your income goal and turns it into a strategic long-term investing goal. But a lot of people don't have that. Again, they're collecting investments, hoping everything turns out rather than investing towards a strategic outcome. So beginning with the end in mind, this is what I mean. If you have an estimate at least about how much income it would take for you to live comfortably without a paycheck, you can turn that into a strategic investing target. And then from that, reverse engineering that target. Here's where you want to be in the future, Gabe. Here's where you're at right now. The course in between, the distance that needs to be spanned, requires X amount of dollars per month. Now you have a finite target. It's not saving as much as you can forever. Let's say you're going to retire in 25 years. Based on where you are now, where you want to be, there's a finite amount of money that you should save every single month to get there. So a couple things that's really powerful. If we just calculated somebody's retirement target, and that's again the amount of money that they need invested to retire and stay retired comfortably for a very long time. It's important to have that specific target. That number is finite. But if I just tell you, well, Gabe, you need $4.5 million to retire comfortably, that can be overwhelming. It also sounds like somebody else's problem. Well, that sounds like 65-year-old Gabe's problem, not today Gabe's problem. So that goes back to the mindset. But if I tell you, well, Gabe, in order to hit that number, you need to save an additional $800 a month above and beyond what you're currently saving. I've done two things. Now I've just made it your problem today. Because now you're not worried about $4.5 million 30 years in the future. You're worried about, I've got to somehow come up with an extra $800 a month, or maybe it's 200 or whatever. But I've turned a multi-decade problem into a 30-day issue. Now every single day is now every single day makes a difference. Every day counts. The other thing I've done is I've broken that huge goal down to small bite-sized chunks. It might still be challenging. It might still be difficult for somebody to get that amount of money invested every month that they need to stay on track for their goal. But it's far less daunting than having a multi-million-dollar target where that's my sole focus. Now, it's important to have that target in the background, but if I have a monthly income, or sorry, a monthly savings goal, every month I get to celebrate a victory. I'm not saying 30 years from now when I'm financially independent, I get to celebrate. It's no, pat yourself on the back. You've hit a milestone each and every month, and the milestone might be challenging, but it's not impossible. So by bringing the future into today and making it tangible, that gives people the motivation to get started today and not procrastinate. And by taking that big long-term goal and breaking it down to small bite-sized chunks, it makes it seem like, okay, this might be hard, but it's something I can actually do and wrap my mind around.
It's actually a really good way to look at it. Yeah, because you want to bring that problem into the present.
Mm-hmm.
You want to make it timely. I think one of the biggest mistakes people make is they always think, oh, you know what? I'm still too young. I don't need to worry about retirement. I can start saving in my 30s or my 40s. And I got plenty of time. I got decades, and in reality, you need decades for compounding to work its magic. And so you want to bring that obligation to the present. You want to make it. I like how you phrase that. About the getting back to the whole cash flow mindset. When you look at a safe withdrawal rate, what is the safe withdrawal rate that you recommend to your clients?
It really depends on how growth oriented they are. If you have somebody who has a lot of fixed income, they have to have a smaller withdrawal rate, because you still have to factor in inflation. So if you're in a primarily bond portfolio, and you're looking at maybe historically 5, 6, 7% returns on that portfolio, you're looking also 3% inflation. I might only be able to take 2 or 3% and still leave a buffer for inflation. Somebody who's more growth oriented might be able to get away with 4.5 or 5%. So it depends on the structure of your investments. Going back to kind of what you just said, just a little bit of a metaphor. So I see wealth as like building an orchard. Okay, the sooner in life you plant the trees, the more time they have to grow, the less you have to plant, or the sooner you get there. You can look at a variety of different ways. But now, number one, we got to put out the fires around it because we don't want the forest fire of debt to burn down your orchard. But the sooner you plant, the more time is working for you, not against you. But as it relates to this, we want to make sure that when we're actually harvesting the fruit that our trees produce, that we're not harming the tree, that we're not cutting down the trees to produce the income, that we're taking just what the trees can reliably produce on a consistent basis. We're not consuming the trees, we're just picking the fruit. So for somebody who is still fairly growth oriented and mostly equity based, a lot of our investors are around that 4.5% target.
Mm-hmm. Tell me a little bit more about your ideal client.
Our ideal clients are blue collar millionaires, Gabe. They don't necessarily make a ton of money, but they have good, well-paying jobs, and they're willing to do the unglorious, sometimes mundane things with excellence and execute those day after day, year after year for decades to get them to a place where they no longer need a paycheck. And they're disciplined. They're willing to do the things other people aren't. They're patient. They're perseverance. As you can tell, these are more character qualities than anything else. So you can have a blue collar mindset in any white collar job, but we work with a lot of law enforcement, a lot of oil field workers, a lot of electricians and plumbers, and maybe they own the business, maybe they've been working it a long time, but they're willing to consistently chip away at a long-term goal and do that with relentless commitment. And those are the folks, they're coachable, they're willing to learn what they don't know, and commit to their future selves.
And I've heard that over and over again, that a lot of the people who succeed at this game are people who, like you said, are willing to just do the boring, repetitive checklist type tasks month in, month out, year in, year out for decades. And so you hear people like teachers and police officers who tend to be very good at this because that's what they do. They follow checklists, they follow processes and procedures. And there's this Hollywood story that, wealth building is like this super exciting, glorious thing, where in reality, it's mostly boring, and it's good that it's boring.
And that's why, again, to switch metaphors, you're building a financial house. You shouldn't be super excited about the tools, the hammer, the nail gun, the level. Like those are relatively boring things. The plywood, the 2x4s, boring, boring, boring. That's what makes up your financial house. But moving into that house, that's what's exciting. Having financial independence, having the assets to protect you and to maintain your lifestyle going forward, having the financial freedom to no longer need a paycheck and to be able to walk away from a job and live life on your terms, that's exciting. The investments you use to get there probably shouldn't be that exciting. It is a little bit boring. Sometimes it's mundane. But if people are willing to master the mundane when it comes to investing, that's where the freedom and success comes from. It's not the one thing you did that one day that makes a difference. It's the little things that you do every day. That's what drives the needle.
Chad, what is the compensation model at Veritas? Do you charge by the hour? Do you take commissions on mutual funds or products? Do you take a percentage of net assets under management? How do you do it?
We're mostly fee based, working off percentage of assets. We do some consulting based, fee for service type, but we like to have skin in the game, and if our clients' investments are down, then our paychecks are down too, because there's a lot of power in that when you're going through the middle of a market, a downturn or economic crisis. If you've already made your money, or if you're making the same amount of money and you're telling your client, hey, it's fine, you'll get through this, we plan for this. It has a little different flavor when they know that they're seeing it on paper, you're seeing it on your paycheck. You're in it together. It's like flying somewhere and being in the midst of turbulence. Air traffic control is saying, hey, it's fine, you'll get through this. But your pilot, he's sitting there with you. He's feeling the turbulence saying, it's okay, stay in your seat. We're going to get to our destination. It's going to be just fine.
And what advice would you have for people, the next time there's a recession or the market pulls back? Half the time these economic forecasts are wrong, and half the time they say there's this, doom and gloom recession coming. Half the time it never arrives. But let's say it does arrive. What should people not do?
What should people not do is, number one, don't panic. And I always say, look for opportunity in the midst of obstacles. So if you have a long-term focus, and that's why it's so hard in the midst of doom and gloom and all these market prognosticators, and everything is on a relatively short timeline. And it's really hard to think 20 years down the road when our world is focused on the next 20 minutes. But if you are a long-term investor, now that you could still be retiring in 2 years, that's still a 20-year investment. Market goes down, the economy's in the toilet. Most people call that a crash. I call it a sale. You have an opportunity to buy the best companies in the world at a discount. Or maybe it's in real estate. Real estate tanks. All the real estate you already own tanks. Okay, you're not going to sell it. Not today, not tomorrow, maybe ever, because we're focused, again, on long-term income. You don't take your fourplex to Costco. You don't take your 401k to Costco. You take your income. So if there is an economic downturn and you have the opportunity to buy assets at a discounted price, embrace the sale. It's difficult, it hurts, but hurt is different than harm. And if you're willing to do the things that other people are not willing to do, you're going to end up in a place where most people never get.
On that note, Chad, where can people reach out to learn more?
Veritas Alaska is our website. And now don't let the name fool you. We're working with folks all over the United States, but we're founded here in Alaska, and it's got some cachet to it. And they can follow us on Instagram at veritas.alaska as well. We try to post regular encouraging and educational content there.
Fantastic. I'll put those links in the show notes. I really enjoyed our talk today. Chad, thanks very much for your time.
Gabe, my pleasure. Thanks for having me.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors and it helps attract new viewers to the show. We appreciate your support. Thanks very much.